Have you ever looked at a stock, really looked at it, watched it, just completely ignore every traditional investing rule and found yourself just scratching your head thinking, what on earth is actually going on here? Well, today we're plunging right into one of the most talked about, maybe most perplexing puzzles in the market today, a place where, sentiment often seems to just blow fundamentals completely out of the water.
Welcome to the deep dive. Our subject, it's GameStop Core, that's NYSE, ticker GME. And our sources for this, well, they come from a really comprehensive stock analysis report. It offers a very particular, data-driven view on what might be really happening beneath all those flashing headlines.
Exactly. And our mission today is pretty straightforward. This report, it sort of peels back the layers on GameStop to reveal what it calls this tale of two companies. It's fascinating, really.
Companies? How so?
Well, on one hand, you've got this struggling legacy retailer, the brick and mortar stores we all remember. But then there's this other side that's emerged, something almost entirely different, a de facto cash-rich holding company.
Right. So our goal is simple. Cut through all that noise. Give you, our listener, a clear, fundamental perspective on this really unusual situation. We want to shed light on the complex forces, pulling it in different directions, and hopefully give you that real aha moment, that moment where you kind of understand why this stock behaves the way it does.
Okay, yeah, let's definitely unpack that. This dichotomy sounds key. So to really get GameStop today, we probably need to start at the beginning, right? What was that traditional business model? The one that, put it on the map for millions of gamers.
Right. Traditionally, GameStop was that quintessential spot for gamers. You went there for the big new releases, obviously, but it was more than that. The report breaks down its main revenue streams like this. First, hardware and accessories. That was the biggest chunk, about 54.9% of sales. Think consoles, controllers, headsets, all that gear.
Okay.
Then you had software. That's about 26.3%. We're talking physical game discs, cartridges, and finally, a segment that was growing, collectibles, at around 18.8%. The Funko Pops, T-shirts, posters, that kind of stuff.
Oh. And the absolute linchpin, almost legendary, was that buy-sell trade program, wasn't it? Bringing in your old games for credit. I remember doing that all the time.
Oh, absolutely. That pre-owned business. It wasn't just a handy service. It was a core profit driver, a really vital engine. Our sources suggest the gross margins on those trade-ins were apparently twice as high as selling a brand new game.
Wow, twice as high.
Yeah, it wasn't just about profit either. It drove people into the stores constantly. It offered real value, and it really, set GameStop apart. But, and here's the kicker, the fundamental challenge, the existential threat, as this report puts it. That high-margin trade-in model is completely tied to physical games. And as the whole industry just keeps marching irreversibly towards digital downloads and cloud gaming, the pool of physical games just shrinks and shrinks.
So less trade-ins possible.
Exactly. And when physical games fade, GameStop's most profitable business line just gets systematically eroded. It's not just like a tough competitor showing up. It's the entire ground shifting beneath their feet, attacking their core profit formula.
So, okay, with that kind of pressure, that existential threat you mentioned on their most profitable segment,
Yeah.
how does GameStop even position itself now in this, rapidly changing market? Who are its main rivals these days?
Well, look, GameStop is still technically the world's largest specialty video game retailer. It has strong brand recognition, no doubt, and still a very loyal customer base, almost a community feel sometimes.
Right.
However, the report is really clear.
Yeah.
Its relevance in the overall video game market, the one that's rapidly digitizing, is shrinking significantly. And the competition, it's just brutal. You've got the big mass market players like Walmart and Best Buy who can bundle games with TVs or whatever.
Sure.
You've got the e-commerce giants, primarily Amazon, delivering games sometimes same day. And then the most disruptive force, the digital storefronts run by the console makers themselves.
Ah, like the PlayStation Store, Xbox, Nintendo's eShop.
Precisely. They bypass retail completely. Developers and console makers keep pretty much all the revenue. So GameStop is still dominant in its niche. But, as the report nicely phrases it, it's like being a dominant player on a shrinking battlefield.
That's a really vivid image. And what's also sort of paradoxical here is that the global video game market itself, it's actually booming, isn't it? It's not like people stopped gaming.
Exactly. And this is a really important distinction to make. The global video game market, it's projected for massive growth. We're talking over 10% compound annual growth rate, hitting somewhere between, say, $435 billion and $600 billion by 2030. Huge numbers.
Massive.
But, and this is the critical insight from our source material, this growth, it's almost entirely happening in mobile gaming, digital downloads, and cloud streaming. These are all segments where GameStop has, frankly, minimal presence. Maybe none.
So the tide is rising, but GameStop's boat isn't really in that part of the ocean.
That's a great way to put it. The very trends fueling the industry's overall boom are the same trends actively undermining GameStop's traditional existence. It's not really participating in the growth, it's kind of becoming a casualty of how the industry is evolving.
That is quite a sobering thought. Okay, so if the core business is genuinely in decline, what did financials actually show us? Let's look at the numbers. What about the top-line revenue?
Yeah, looking at the income statement, the revenue trend is, well, pretty stark. Our sources highlight a consistent decline. There was maybe a brief bump around the pandemic, FY 2022, but since then, sales have fallen steadily. From a peak near $6 billion in FY 22 down to just $3.82 billion in the trailing 12 months, the TTM period. Yeah, it's a significant drop. This sustained top-line erosion, it's a clear proof of those big secular challenges we were just talking about. It's not subtle.
Now, usually that kind of revenue drop would mean big losses, right? Bleeding cash. Yet, I've seen headlines saying GameStop actually reported a net income recently, a profit. That sounds like a turnaround, doesn't it? What does the report say about that?
Okay, yeah, this is where it gets really interesting. And it's one of those potential aha moments for sure. For years, yes, GameStop was posting significant net losses. But the report points out that in fiscal 2024, they did report a modest net income, about $7 million, and that grew to $131 million in the TTM period.
So profitable.
On paper, yes. But here's the twist, and it's crucial. This return to profitability was not because they started selling more stuff or making more margin on games.
No.
No. In fact, our sources reveal this profit is largely, you could say, a financial construct. It was achieved mainly through, one, drastic cuts in the selling general and administrative expenses, SG&A.
Yeah.
Basically, aggressive cost-cutting, layoffs, store closures, that sort of thing.
Okay, belt tightening.
Right. And two, fascinatingly, a substantial increase in interest income.
Interest income. From what?
From the massive pile of cash they now have sitting on their balance sheet. So think about it. A company whose supposed profitability isn't really coming from its core retail operations, but from slashing costs to the bone and earning interest on cash. That's the artificial inflation the report talks about. The profitability is being subsidized by these non-operating factors.
Okay, that makes a lot more sense now. But it immediately leads to the next big question. Where did this massive cash balance even come from? If it wasn't generated from selling lots of games profitably, that's a huge war chest for a retailer described as struggling.
This is really the defining feature of GameStop's recent transformation. It's unlike almost anything you see in traditional retail. The balance sheet, according to our source, shows this just dramatic surge in cash and cash equivalents. It soared to an incredible $6.4 billion as of the first quarter of fiscal 2025.
$6.4 billion.
Wow. And crucially, this wasn't money earned from selling more consoles or profitable trade-ins. It was primarily raised through what are called at-the-market equity offerings, or ATM offerings. Meaning, in plain English, they funded it by selling vast amounts of new shares of GameStop stock directly into the market to the public. This significantly diluted the ownership stake of existing shareholders.
Ah, so the cash came from shareholders, not operations.
Precisely. The report confirms that their cash flow from operations was negative for years, persistently negative. It only just recently nudged slightly positive in the TTM period. But if you look at cash flow from financing, you see these massive inflows from issuing stock. This fundamentally changed the business. It went from being primarily a retailer to being, in effect, a capital management firm or a holding company. It's a totally different beast now.
Okay, so they're sitting on this mountain of cash, $6.4 billion, but it didn't really come from their day-to-day business. What does that actually mean for the company's financial efficiency? I mean, how well are they actually using all those assets?
Yeah, that's a critical question. How effectively is GameStop deploying that capital? And the numbers here, according to the analysis, are quite revealing. If we look at key financial ratios, first, debt to equity, basically how much debt versus shareholder money they use, it's exceptionally low, almost no debt.
Okay, sounds safe.
And their current ratio, which measures short-term financial health, ability to pay immediate bills, is extraordinarily high, like 8.39. Now, normally, a healthy retailer might be around 1.0, maybe 1.5.
So 8.39 is very high.
Extremely high. While it definitely means there's zero solvency risk, they aren't going bankrupt from debt anytime soon, it's also a flashing red light for extreme capital inefficiency. A healthy company doesn't just hoard cash like that, holding over 8 times more current assets than current liabilities, especially when that cash isn't being actively used to generate returns in the core business.
So the cash is just sitting there.
Largely, yes. And the most telling metric highlighted in the report is asset turnover. This measures how much revenue the company generates for every dollar of assets it owns. GameStop's asset turnover is catastrophically low at 0.65.
0.65. How does that compare?
It's world apart for peers. Best Buy is at 2.94, Target is 1.93. So think about it.
Hmm.
For every dollar of assets GameStop has, and remember, most of that asset base is just cash. They're only generating about 65 cents in annual revenue.
Whereas Best Buy generates nearly $3.
Exactly. And Target almost 2. It's like having this huge state-of-the-art factory, the cash pile that's barely producing anything. This profound inefficiency is a direct result of that ballooning cash balance combined with plummeting sales. The money just isn't working for them. It's effectively idle.
Mm.
And even return on equity, ROE, which measures profit generated per dollar of shareholder equity, is way lower than peers. GameStop's is around 6.6%, whereas others might be in the 30% to 50% range.
Mm.
That's another big red flag for a traditional business perspective.
Okay, so putting this whole financial picture together, we have a struggling core business, declining sales, profitability propped up by cost cuts and interest income, and a massive cash pile raised by selling stock that's being used very inefficiently. Given all that, how on earth do you fundamentally value a company like GameStop using traditional methods?
Right, and this is exactly where we hit that profound disconnect. The
Yeah.
report talks about the huge gap between GameStop's actual stock price in the market and its estimated intrinsic value based on fundamentals.
So what do the models say?
Well, using a discounted cash flow model,
Hmm.
or DCF, which, tries to estimate all the future cash a company might generate and discount it back to today's value, even making pretty conservative assumptions, like maybe a negative 5% revenue growth rate going forward to reflect that ongoing decline.
Yeah.
The implied share price comes out somewhere between $5 and $8.
$5 to $8 compared to, a much higher market price recently.
Exactly, a tiny fraction of where it often trades. Now, if you cross-reference that with relative valuation multiples, comparing GameStop to its peers, the picture gets even starker.
How so?
GameStop's price-to-earnings ratio, PE, has been close to 50 times its earnings recently. Its price-to-sales ratio, PS, around 2.7 times revenue. Now compare that to much healthier, stable retailers. Best Buy trades at a PE of about 10.7x and a PS of just 0.3x. Target is around 11.7x PE and 0.5x PS.
So GameStop's multiples are way, way higher.
Dramatically higher. A company with declining sales and, frankly, fragile, artificially supported profitability just fundamentally shouldn't command a valuation premium that's, 4 to 8 times higher than its healthier, more efficient competitors. So reconciling these different valuation approaches, our sources conclude that GameStop's fundamental fair value range is probably somewhere between $4 and $9 per share.
Okay, $4 to $9 fundamentally, versus a market price that's often multiples of that. The numbers are just screaming that it's fundamentally overvalued. So how do we make sense of this? Why is there this enormous chasm? This really is the core of the puzzle, isn't it?
It really is. And what's truly fascinating here, and the report really digs into this, is the whole meme stock phenomenon. It concludes that GameStop's price is, for the most part, driven primarily by social media sentiment, by the strong belief of a very large and loyal retail investor base, and by extreme volatility, fueled by speculative trading, short squeezes, things like that.
So it's not about the business performance.
Fundamentally, no. The report argues it's become a speculative vehicle where the trading behavior is almost completely divorced from the underlying performance of the actual company selling video games. For many shareholders, the report suggests the product they're buying isn't really a claim on future cash flows from retail operations. It's the stock itself.
The stock is the product.
Yeah, as an asset representing maybe a social movement or a vehicle for pure speculation, a bet on those wild price swings. It's become an investment based more on community, conviction, and narrative, rather than traditional financial metrics.
But hang on, what about something else we often hear reported, the negative beta? Sometimes cited around, minus 0.8 or so? Doesn't that imply it's like a safe haven? Something that goes up when the rest of the market goes down. A good hedge for your portfolio. That's a common narrative.
Yeah, that's a really important point to address, and the report clarifies this quite carefully. That negative beta. It's essentially a statistical quirk, an artifact of why its price moves.
Meaning?
It means its price action has often been uncorrelated or even inversely correlated with the broad market because it's driven by that unique idiosyncratic retail sentiment we just talked about, not by typical economic factors.
Mm,
But, and this is critical, it should absolutely not be mistaken for a safe haven characteristic or a reliable portfolio hedge
right.
because it represents unpredictable, sentiment-driven volatility, not fundamental stability. In fact, our sources warn that in a really severe market crash, that negative correlation could suddenly flip positive at the worst possible time. Imagine retail investors being forced to sell everything, including GME, to cover losses elsewhere. So that negative beta, it's more a sign of unreliability and unpredictable swings, not a protective shield for you.
Got it. Okay, so we've unpacked a lot. The struggling core business, the cash raised by selling stock, this huge valuation gap, the meme stock dynamics. What does this all mean for you, the listener, as a potential investor, and what are the biggest risks you should be aware of?
Well, first and foremost, the report stresses that GameStop, the retailer, lacks any real durable competitive advantage, what investors often call an economic moat. If you analyze it using something like Porter's Five Forces, a framework for looking at industry competition, the pressures are intense from every angle. Threat of new entrants is high, buyer power is high, and crucially, the threat of substitute products, digital downloads, cloud gaming is extremely high and growing. But what's particularly dangerous, and the report highlights this, is that GameStop's most important suppliers, Sony and Microsoft, are also its most formidable competitors. These console makers have every financial incentive to steer customers away from physical retail like GameStop and towards their own high-margin digital stores.
Mm.
They're actively working to make GameStop's original business model obsolete. It's like they're, selling GameStop the rope to hang itself with.
Wow, that puts them in an incredibly tough spot strategically. But what about the leadership, the management team? What's the plan for that $6.4 billion cash hoard? Is CEO Ryan Cohen outlining a vision for transformation?
This is another major area of uncertainty highlighted in the report. The management team, led by CEO Ryan Cohen, is largely new, and their strategy for using that massive cash pile, it's described basically as undefined and opaque. Yeah. They don't hold quarterly earnings calls with analysts anymore. They don't provide forward guidance or projections. That's highly unusual for a public company. So the investment thesis for GameStop, according to this analysis, has shifted completely. It's no longer about fixing the retail business. It's become a faith-based bet on Ryan Cohen's personal capital allocation skills to pull off some kind of transformative acquisition with that cash.
So it all hinges on him making a brilliant deal.
Pretty much. And that introduces huge key man risk. The company's future becomes heavily dependent on just one person's decisions and vision. It also brings the risk of value-destructive acquisitions. The report touches on the idea of diversification.
Diversification.
Yeah, it's a somewhat cynical term, but it means when a company diversifies into totally unrelated businesses and ends up actually destroying shareholder value instead of creating it, because they don't really know that new industry. It's a real risk when you have a huge pile of cash and an unclear mandate.
Okay, so if you had to summarize the absolute critical risks you, as an investor, need to be aware of here, beyond just the core business slowly fading.
I'd say the report boils it down to these key things. One, the ongoing existential risk from digital disruption to the core retail business. Two, significant execution risk and capital allocation risk. What will they do with that cash, and will it work? Three, that key man risk tied specifically to Ryan Cohen and his undefined strategy. Four, the potential for further shareholder dilution. They've shown they're willing to sell stock. They could do it again. And five, underpinning everything, is the extreme volatility itself, which can lead to sudden, severe losses if sentiment shifts rapidly. It's a high-stakes environment.
Absolutely. Given all those headwinds in this really unique situation, what's the future outlook painted by the report? What are the chances of things turning positive versus negative?
The outlook presented is definitely tilted towards challenges. Our sources emphasize several high-probability headwinds. First, the continued, likely unavoidable deterioration of that core physical retail business. Second, the potential for retail investor interest to eventually wane. The meme stock narrative might not last forever. And third, the risk of actual cash burn if operational losses start to overwhelm that interest income they're currently living off.
And the potential upsides.
Those are seen as much lower probability catalysts. Things like maybe they pull off a truly transformative, genuinely value-creating acquisition, something that fundamentally changes the company's prospects. That's possible, but hard. Or perhaps another unpredictable short squeeze happens, driving the price up temporarily. But, you can't predict those, and it's certainly not a sustainable investment thesis.
Right. So, bringing it all together then, we've dissected the declining fundamentals, the unusual cash situation, the massive valuation disconnect, the meme dynamics, the significant risks. What is the ultimate conclusion? What's the recommendation from these sources for a knowledgeable investor looking at this through a traditional fundamental lens, say, over the next 12 months?
The conclusion is pretty stark. GameStop is truly a company of two completely distinct and, frankly, conflicting parts. You have the legacy retailer facing what looks like an irreversible decline, lacking any real competitive defenses. That's part one. Then you have part two. Effectively, an investment holding company, flush with cash raised by diluting shareholders, led by an activist investor with a strategy that's largely a black box. And the report concludes that the current market price, the stock valuation, is almost entirely a reflection of speculative hope baked into that second part, while it simultaneously ignores or dismisses the deteriorating reality of the first part.
So the market's betting entirely on the unknown future, ignoring the known present.
That's the argument, yes. Therefore, for a knowledgeable investor, someone prioritizing fundamental analysis, looking at risk versus reward over, say, a 12-month horizon, the proposition offered by GME stock is seen as exceptionally poor. The risks seem to vastly outweigh the potential rewards based on the underlying business. The recommendation, stemming directly from this data-driven analysis, is unambiguous. So,
It really is an incredible story. GameStop's journey is just such a powerful, almost extreme example of how market sentiment driven by these unique social factors, this passionate community, can create such a profound and potentially prolonged disconnect from what traditional fundamental analysis suggests a business is actually worth. It leaves you thinking, doesn't it? What does GameStop's wild ride really tell us about the nature of value itself in today's markets? And maybe more importantly for you, where does your conviction truly lie when you decide to invest your capital? If you want to stay ahead of the curve, get deep dives like this one that cut through the noise on complex situations, make sure you hit that subscribe button. You'll get the fastest and most frequent updates. We're here to help you get to the core of what truly matters in these markets.